Hi, and welcome to problem 3.8. So this is a video about the background for problem 3.8 because problem 3.8 is really interesting in the whole life insurance setup, since it really is the only exercise in chapter 3 that tells us about just this whole life insurance contract thing in general. So before we start doing the solutions, I will suggest that we take a quick look at life insurance in general, what it's about, and we try to understand some of the notation that is in chapter 3. So, life insurance. Now, you probably recall the symbol TX from the book, which stands for the remaining lifetime of an X-year-old. So why are we interested in this thing? I mean, why are we even interested in insurance, in life insurance? Well, the thing is that we often regard insurance as a kind of safety net against uncertainty. So, for example, we buy bike insurances because we're uncertain whether our bike will be stolen or not. We buy fire insurances because we are uncertain whether or not our house will be burnt down by fire, and so on. And we buy life insurance due to the uncertainty that comes from the fact that we do not know our remaining lifetime. So the uncertainty comes from the fact that the remaining lifetime Tx is unknown. So the thing is, if I stand here at my age and I say, I know that in exactly 20 years' time, I will die. In exactly 20 years' time. Then it's really quite easy to plan my finances, right? Because then I will just maximize however I can with regards to the 20 years I have left. However, when the remaining lifetime is unknown, as it is for most of us, when it's unknown, it's kind of hard to plan. So the question kind of pops up, right? How should I plan my life when I don't know how much longer I will stay alive? So how should I plan? And then I'll just not write my life because that's a really big question. So since we are working with financial mathematics, I'll just write how should I plan my finances when I don't know how much longer I have to live. How much longer I have to live. Well, the thing you can do is you can kind of try to guard against different circumstances, right? So you can guard against the circumstance where your remaining lifetime will end up being very short. For that, you can buy an insurance that pays out if you die too early. You can also buy an insurance that pays out if your lifetime ends up being very long. In that case, you will buy a pension or so-called life annuities or pure endowments that will pay out in case you reach retirement. I know it shouldn't sound like a bad thing, but for the insurance company, sometimes it can be a bad thing. And also for you, if you have not saved enough money for old age, right? So there are two kinds of risk. There is one kind where you risk your remaining lifetime being too short, and there's also the other kind where your remaining lifetime can be too long. So it can either be too short, so Tx too short is one problem, Tx too long is another problem. And the short solutions for these is if it's too short, then we buy a term insurance so that at least our remaining family members have some money to live off of when we can't contribute to their lifestyle anymore. And if TX is too long, aka you will be in retirement for too many years and then you won't have enough money saved up, well, in this case, we can buy something like a life annuity. So pension that pays out every month and keeps you good and safe and sound. Now, the thing is, how do we construct such products? And how do we make these products make sense? So how do we construct such products and how do we make these products make sense? And for this, just before we delve into the whole life insurance contracts thing, I would like to show you guys two examples. So the first example is this thing here. Just trying to find the right color. Okay. So 10 fishermen go to sea because they need to catch fish. Now, they know that the waters are pretty dangerous out there, so maybe not all of them can come home alive. Right? And if they can't come home alive, then it means that their family won't have anything to live off of. So that would be a problem. And that would be worrisome. So each one of them knows there is a certain risk that I might die out at sea. How can I make sure that my family still has enough money to put food on the table? Then they say, well, let's just all put some money into a common box. Let's say we put in $10 each. It might be 10,000 or something, but let's just say they put in $10 each. Then they all go out to sea and one of them dies. And the person who dies, the family members of that person's family will receive the total savings here. So this is actually what we call a term insurance. Term insurance. Now, what would be the reason for everybody to be interested in such a contract? Well, the reason is this. Well, if you don't die at sea, then that's true. You just lost $10, right? However, if you do die at sea, then your family members will have earned more than $10. So since everybody has an interest in the total savings, then everybody would also like to contribute a little just to have a safety net in the case that they die at sea and their family members will be left without anything. So this is what we call a term insurance. Now you might say, okay, but what if half of them dies? Then this thing doesn't really work that well. And also there are only 10 people, right? So it's kind of like this insurance would probably work a lot better if you had 1,000 people and you didn't expect that many people to die. So this is the philosophy behind term insurance. Now let's take a look at the philosophy behind pension, which is the other case. So for pension, what we can think of is this. Again, we have 10 guys who decide that, well, let's just say we have 4 because I don't want to draw more people. So they have 2 choices. They can save money up in the bank or they can put them into a common savings account. So they can deposit their pension money, their retirement money, into a common savings account. Now, what's the difference between these 2 cases? If each of them deposits their money in the bank, then in the case that one of them dies, then the money will just, it will just, it won't benefit them in any way. However, if all four of them deposit their money into one common account, then in the case that one of them dies, then the other three will actually get more money, right? So if each of them deposits, so if each of them contribute to 1/4 of their common savings and one guy dies before retirement, then this chunk of his will be divided equally among the other three. And that is why pension savings often give you a higher interest than saving up in the bank. This is what we kind of call interest by death. So that is how pension works. Now, I hope that this kind of gives you guys a little bit more intuition about life insurance. This is just the basic intuition video number 1. In the next video, I would like to talk with you guys about how life insurance companies decide how to price such contracts and just the general way of working with these different products that depend on remaining lifetime. So see you in the next video.